Gramm-Leach-Bliley Act, or GLBA. Part 1. Understanding Financial Privacy and Information Security. So, why was GLBA passed in the first place? GLBA, also known as the Financial Services Modernization Act of 1999, was enacted on November 12, 1999, during the Clinton administration. The main goal was financial modernization. Before GLBA, federal law generally kept banks, securities firms, and insurance companies separate. GLBA removed many of those barriers, allowing financial companies to offer a broader range of financial services under one corporate umbrella. But as financial institutions expanded their services, they also began collecting and sharing increasing amounts of consumers' personal financial information. Congress responded by including privacy protections in GLBA. So, in simple terms, GLBA modernized the financial industry, while also establishing rules to protect consumers' financial information. Who must comply with GLBA? GLBA applies to financial institutions, and that definition goes far beyond traditional banks. Under GLBA, a financial institution generally includes any company that is significantly engaged in financial activities. That can include banks and credit unions, mortgage lenders, insurance companies, investment advisors, securities firms, and even certain tax preparation businesses and fintech companies. And here's the key takeaway. It's not simply about what a company calls itself. It's about the activities the company actually performs. GLBA does not protect all personal information. It specifically protects non-public personal information, or NPI. In the GLBA context, NPI is personally identifiable financial information that a consumer provides to a financial institution, information that results from a transaction with the institution, or information the institution otherwise obtains in connection with providing a financial product or service. This can include information such as Social Security numbers, income, account numbers, loan information, credit history, payment history, and investment information. Importantly, publicly available information generally is not considered NPI. For example, information obtained from government records or widely distributed media is generally outside this definition. One important distinction under GLBA is the difference between a consumer and a customer. A consumer is someone who obtains or seeks to obtain a financial product or service, but does not necessarily have an ongoing relationship with the financial institution. For example, someone who applies for a mortgage, cashes a check, makes a wire transfer, or applies for insurance without ultimately purchasing the policy may be considered a consumer. A customer, on the other hand, has an ongoing relationship with the financial institution. Examples include a bank account holder, mortgage borrower, credit card holder, investment account owner, or insurance policy holder. The key takeaway is simple. Every customer is a consumer, but not every consumer becomes a customer. Why does GLBA distinguish between consumers and customers? Because customer status creates additional compliance obligations for the financial institution. Both consumers and customers are protected by certain GLBA requirements, including restrictions on the disclosure of NPI and protections under the Safeguards Rule. The key difference is privacy notice requirements. A customer generally must receive an initial privacy notice and an annual privacy notice, subject to applicable exceptions. A consumer who does not become a customer generally does not receive the same notice requirements. So, the distinction matters because an ongoing customer relationship triggers additional privacy notice obligations for the financial institution. Now let's turn to the GLBA Privacy Rule, which is the core of the privacy protections under GLBA. The Privacy Rule governs how financial institutions may disclose non-public personal information, or NPI, rather than prohibiting disclosures altogether. It establishes the conditions and limitations that apply when NPI is shared. The Privacy Rule has three primary objectives. First, transparency. Financial institutions must provide consumers with information about their privacy practices, including what information they collect, why they collect it, and how they use and disclose it. This is communicated primarily through privacy notices. In other words, transparency is about what the financial institution tells the consumer. Second, consumer control. In certain circumstances, consumers have the right to opt out of certain disclosures of their NPI to non-affiliated third parties. This is not a general right to prevent all sharing of financial information. The right to opt out applies only to specific types of disclosures covered by the Privacy Rule. So, control is about what the consumer can choose. Third, disclosure restrictions. This is about what the financial institution is legally permitted to do with NPI. The Privacy Rule regulates when NPI may be disclosed, to whom it may be disclosed, which disclosures require an opportunity to opt out, and which disclosures fall within an exception to the opt-out requirement. So, while transparency is about what the institution tells the consumer, and control is about what the consumer can choose, disclosure restrictions are about what the institution is actually allowed to do. These three concepts, transparency, control, and disclosure restrictions, provide the framework for understanding the rest of the GLBA Privacy Rule.